Well, the response to bank earnings that we've seen so far in the U.S. has been to bid up the sector. In fact, it's one of the reasons that the KBW Bank Index is up 22% from its May lows. And in fact, when you look at the regionals, the outperformance is even more stark, up nearly 30% from the lows. And of course, that has been the crux of the pain point since the Silicon Valley Bank collapse. And you can see that even with that rally, we're still nowhere near the levels as a sector that we were before SVB took hold. Our next guest covers the regional banks within the United States and says you got to be selective within the sector. It's not a wholesale buy. Let's bring in Alexander Yokum, equity research analyst at CFRA Research. Alex, thanks so much for being with us. Before we dive into the nitty gritty, I'd love to just get your assessment of what comfort or what concerns the earnings season from the U.S. banks, particularly the regionals, brought you.
Yes, thank you. Thank you for having me on. I think overall it was a really strong second quarter. In the first quarter, there was a lot of solvency concerns. There were large deposit outflows at many banks. So that brought a lot of concern. And I think you saw that in the valuations. A lot of banks were trading at COVID levels, right? Peak 2020 danger territory. That has reversed largely this month. Solvency issues have really fallen off. We saw a majority of banks that struggled in the first quarter actually saw deposit inflows in the second quarter. The concern there a little bit, though, was they had to pay up for those deposits. So we saw funding costs increase a lot. But in terms of solvency issues, those really fell off. And I think that's why we've seen such strong performance in this second quarter. And just to sort of highlight that, the most beaten up stocks and the ones with the most negative sentiment, so we're going to call those regional banks with 5% plus short interest, they have actually gone up 27% on average in the last 30 days.
And are those names that you are willing to get into? Is that a little bit too far out into the risk spectrum? How are you thinking about screening for opportunities right now?
Yeah, so we have been a little bit cautious on those names just because their earnings are going to be severely depressed going forward. But we do think a little bit of a bounce was warranted because, like I said, the valuations were so beaten up. So it sort of went from solvency thoughts to profitability thoughts. So some of them we're a little bit more bullish on, but in general, we do think banks that saw significant deposit outflows in the first quarter, although that stabilized in the second quarter, they did lose some of those core customers, those core deposits. So going forward, it's going to be harder to do business. So
we often think about regionals in one camp and the large banks in the other because they are, they have that magic word diversification. They've got capital markets, they've got wealth management, whereas the regionals are just more exposed to pure lending. But within regionals, can you extract some that are doing a better job on business line diversification?
Yeah, so the kind of the super regionals, as you might say, are definitely better there. So that's the PNC, the Truist, and the U.S. banks of the world. But we definitely prefer PNC there. And that's because U.S. Bank and Truist, they actually have large unrealized securities losses. So that is, what's similar to what took down Silicon Valley Bank. I'm not expecting those banks to go down, but the problem is future regulatory requirements might require them to account for those unrealized losses in their capital ratios. So they're going to have to build up more capital, therefore returning less to shareholders in the medium term, whereas a bank like PNC is actually positioned pretty well. They didn't expose themselves to too much risk in the low rate environment, and they actually outperformed in the recent stress test results we got in June. So we think PNC is the best of the bunch for those.
That's in the U.S. I know you cover Canadian regionals as well, or smaller scale banks, Laurentian and National, and you're positive on those.
Sorry, no, I do not cover.
Oh, sorry, I saw that in your list of positive on diversified, so we'll set that aside. Which are some of the names, and you kind of alluded to it, within the regionals that you would be skewing away from?
Skewed away from. So yes, so banks that we think have a deposit concern, right? And deposit concern, now we're talking about more funding costs. So, banks like Comerica and Zion, we're neutral on just because of their valuations. But we are a little bit concerned with their funding costs because they have high levels of non-interest bearing deposits. So the problem is in a low rate environment, that's very good. But as rates have gone up, those customers are starting to look for yield. So they're switching to either more expensive funding or they're just losing those deposits as it is. So, we're a little bit more concerned with those companies. Yeah.